We spend so much time looking at details of the market, short-term studies, and as you know, I tend to look at a lot longer-term studies than most. I'm looking at dailies, I'm looking at weeklies, and very rarely am I looking at very, very short-term charts, 5-minute, 10-minute, 15-minute charts, things like that. We have been focusing on, in terms of our Elliott wave count, really on an intermediate count. There's the major count above that, and that's the super cycle, and that's kind of what I want to talk to you about today. Because what is very interesting is once we broke above that long-standing resistance line, we had an alternative model that could be unfolding. And here's what I mean. Whether or not we are currently in a counter wave, meaning we went absolutely into the bear count, completed the fifth wave, and then, as I said, we should get some sort of an A, a B, and a C. So whether that is the correct model or what we did when we look at the big picture, and I'll show you that in a second, is had a large ABC down here. We concluded that and we went back into an impulse phase. The difference between a counter trend and an impulse phase is very, very apparent, but not at the beginning, because on an impulse phase, you're going to get a wave 1, a wave 2, a wave 3, a wave 4, and then a wave 5. So when you think about it, the beginning of either a counter trend, ABC, or a full-blown impulse phase, 5 waves, the beginning of it, they're very, very similar. In other words, the criteria that needs to develop is correct in both models. And so we really won't have absolute confirmation if and when or until this market begins to trade at 1435, and then we can ascertain whether or not we're in a counter trend or a full impulse cycle. But my sense is that we are definitely in a different type of market, and there is a real possibility that after breaking through this particular long-standing resistance line, we could have entered into a bullish impulse phase as opposed to a counter trend. And to kind of illustrate that example, I want to pull up a very, very long-term study. This study here is simply a 2-week chart. Every candle, it's in Japanese average format, but every candle represents 2 weeks in time. And this type of chart really would only be used for the absolute big picture in the market. Let's go ahead and remove some of these trend lines. And what I mean to say is this. When we look at any cycle in Elliott wave, we have 1, 2, 3, 4, 5. That's our impulse, then an A, a B, and a C. To some degree, that is what the 8 count itself. Now, within that 8 count, you can then take a look at this particular 1, 2, 3, 4, 5 as simply being a 1. And then we can look at this ABC as being a 2. And so forth. So really what it does is it allows us to look at a much bigger picture. And here's why I believe it's so important. If in fact we look at our major count, this of course 1, 2, 3, 4, 5, ABC, 1, 2, 3, 4, 5, ABC. So what that really tells us, and this is what I'm so excited about, is that rather than this being a counter trend in terms of our super cycles, we could be looking at this: major first, major second, major third, major fourth, and if that's correct, we are now in our major fifth wave, and our major fifth wave by its own nature should in fact take us to a new price high. Now, a new price high, I'm looking at a period of time that's going to be, or a cycle I should say, that could be anywhere between a year and 2 years. If we take this as 2011 to 2014. So you can see the amount of time, 1 year, 2 year, almost 2.5 years for this basic downtrend to kind of complete itself. If we look at this super cycle from 2008 up to the end of 2011, again, you can see that these cycles take some time to unwind. These are major counts in terms of our Elliott wave count, and they are super cycles. You can see this chart goes back to 2001. But what I'm most excited about is that for the first time in a long time, because we've had this dramatic sell-off in the marketplace, but for the first time in a long time, I can actually see some light at the end of the tunnel. And the light that I'm seeing is a potential for a super bull run back to the upside. Now, when we take a look at this big move, I put in two basic fib retracement. These fib retracements that I'm looking at are really the rallies from 1 and the correction to 2, the rally to major third and the correction to M4. And what you see when we do this is we got basically a 50% retracement, and in here we got a 61% retracement of these moves. So we do have some validity in terms of having some technical evidence, compelling technical evidence that lets us use this model as a valid model. And as I said, this is not long-term or not short-term by any means. This is very, very long-term. This is something that I'm looking at unfolding over the next 2.5 years. But what is most exciting is that for the first time in over a year since this market dropped, have I been able to say bullish impulse phase in gold in the same sentence, looking at a longer term move. And that, traders, has gotten me truly exciting, because we're at the doorsteps. We're right at the beginning of something great. And that, to me, is the ability for this marketplace to kind of move and to move aggressively to the upside in terms of where it could go. There's a couple of things that we can do. And what we have been doing is really fib extensions, and as well as some just straightforward Elliott wave trend analysis. In other words, we take a look at the distance of wave 1 and say that 1 and 5 should be equal, and we do our studies from that. And when we look at some Elliott wave extensions, and we've done this before, but what I have added on this particular chart, just as a quick study to see what we're looking at. Wave 1, this is our major 1, major 2, major 3, major 4. This is now our first sets of models that we're looking at in terms of where we think this major fifth could go. Now, what this model is simply looking at is as follows. It's saying that if wave 1 and wave 5 are equal, then what we should do is make a play to go back to this $1,900 area. We might see a double top, but we're actually going to see a marketplace that should move higher. And the interesting thing is, when you see this equal top, what that tells you is that wave 3 and wave 1 were about the same size. Now, realize an Elliott wave, wave 3 cannot be the shortest of any of the impulse waves, fine. But typically what you will get in a fifth wave in gold, we've seen it time and time again, is where that's where it tends to move parabolic. And if in fact we saw something like that, what we would want to do is look at not only a 100% move, but we would want to look at 138% move, 123% move, and then 161% move. Now, we've actually done those studies, and really the conclusions they come to are kind of interesting. If we look at this particular move here, and then, as you can see, we've talked about this before, this is that extension. It really was a 176% move that took us to this record top. If we then take this last wave 3, take it to the beginning or the end of that major fourth, 100% takes you to roughly 1890, and then 161%, which corresponds, I should say, to the 161 extension right in here. So this seems to be a pretty good target. After that, our target would have to be just above 2,000 at 2068. But as I said, traders, this is a long ways away, but it's the first time I could actually get real bullish, very long term. And honestly, that's just a pleasant surprise. And I'm happy to report it to you.